So, is the 50-year mortgage going to be the new way to make loans more affordable? Let's look at that together. Okay, so I've got my trusty sketch pad here, and I'm going to write down some numbers for you so you can see what it's going to really look like. First of all, let me talk about the 50-year mortgage compared to the 30-year mortgage. Okay, that's 20 additional years on your mortgage. They're saying it's going to be more affordable to help affordability for buying homes. If the interest rates were the same on the 30-year compared to the 50-year, then it could, on an average loan for Tennessee, for the average home, it could save the average consumer about $250 a month. Okay, I know that is significant and that's good. $250 a month. It would cost, though, because you're adding 20 years to the mortgage, you're paying interest for 20 additional years, over $400,000 more. Okay, so I'm going to put the math here. So we're going to do 250. That's going to be your savings. 400,000 is going to be the price you pay to save 250 a month. So 250 a month, so 400,000 over the life of a loan. So do you really want to do that? I would definitely say no. I don't think the 250 savings is really worth it. And here's the big kicker of all this. I've been doing this 31 years this year. It's crazy. Time has flown by. The hair has gotten gray or fallen out. And what I've learned in the mortgage industry is that when something like this comes up, that we as a lender have to look at risk, okay? So when you look at today's quote on a 30-year fixed rate, we're probably around 6.25, okay? If you go lower than that 30-year fix to a 20, we're probably around 6. If you go lower to a 15, we're probably around 5.75 to 5.5. Why is it lower when you go lower in term? Because it's less risk for the lender. You're paying down that mortgage faster, you're building more equity. So if you defaulted and there's more equity in the home, then there's a less likely chance that the lender's going to lose money if they had to sell your house. That's really it. We look at risk, just like an insurance company, really. So we look at risk. So if you're doing a shorter term loan, then number one, you can qualify for higher payments because it will be a higher payment because you're putting much more principal in. Number two, you're going to build equity faster. So you're going to have a less likely of a chance to default and owe money at the closing versus getting some money back at the closing because you've got more equity in the home. So take this for what we're looking at, a 30-year mortgage. If you go out to 50 years, that rate has got to be higher because of the additional risk that the lender is taking. So you're not going to get the same interest rate that you do on a 50 and a 30. You're not going to get that unless the government decides that they want to subsidize the 50, right, on their own to make it the same rate, right? If they do that, then that would be up to FHFA to do that and make sure that that works. But you're probably not. Here's an example. We did a 40-year mortgage before. There's been 40-year mortgages out there for a long time. And the problem is the rate was higher to the effect when I looked at a customer's 30-year versus the 40-year, the rate was so much higher that the payments were about equal or actually sometimes more on the 40-year than the 30-year because the rate was higher. Okay, so I don't think the 50-year is a good idea. If they do lower the interest rate to equal the same, it's still not a good idea. It's only saving you $250 a month, but it's going to cost you $400,000 over the life of the loan. Okay, that's why it's very important to have a loan officer that is interested in you and interested in your best interest versus just getting a transaction, right? And that's what makes us different here at Churchill and with our team. Thanks.